there's one final component to our business, which sets us aside, I think, from most of the other asset managers out there, is we spend quite a bit of time looking for opportunistic trades, looking for the $100 that's lying on the ground that no one else is prepared to pick up. We're looking for those little opportunities to spice up the performance of the funds. And we use the derivative background of some of the people in our team, the investment banking background of people in the team, the contacts that we have, etc., to try and play out those opportunistic trades over time.
Just going to pop up a poll quickly, just in anticipation of the slide after this. The question which we're raising is, where do you expect the level of the South African 10-year government bonds to be in 12 months' time? We've just put a few ranges there for you to select. Please do participate.
So the title of the presentation, and I think why you dialed in, is to answer this question: is there still value in value? And I think the best way to start with it is to start with what our macro outlook is, and this is the product of that asset allocation committee that I spoke to. We've got an incredibly strong growth environment in the world at the moment. World growth running at 6% this year, and if you look at how that breaks out, I was looking at it this morning on Bloomberg. US growth is expected to be 6.6%. That is incredibly strong growth for the year. The Eurozone roughly 4.2%, and EM just over 5.2%. The US being the biggest growth driver of global growth. Sadly, in South Africa, growth is probably going to be a little bit less than what we're seeing in the global scenario. We've got 3.5%, but that's probably a little bit conservative. We've been talking to economists over the last few days that are starting to upgrade numbers. There are people even coming through at 4.5% into 2021, but then dripping down again to roughly 2% in 2022 and 2023. We think that US interest rates on the 10-year are going to stabilize at around 2%. We're looking for a 25 basis point hike in interest rates in South Africa into the course of the next 12 months, probably early 2022. And government bonds, we think, are going to be at 9% a year from now. So it'll be interesting to see when Mike throws up the poll what the assembled crowd is thinking. And then on the currencies, we've got the euro dollar set at 125, which means that we think the dollar is going to continue to weaken from here. And then the rand we've got set at 14.75. We always give that a bit of a pinch of salt, because forecasting in currencies we think is a mug's game to a large extent. We give it our best estimate, but I wouldn't put a huge amount of store on the point estimate that we have for the rand. And then oil prices at roughly $60 a year from now. So, Mike?
Yeah, the results?
So most people actually agree with us that it'll be less than 9%. So at least we've got some people that are in agreement. Thanks for putting through those votes. So let's look at, with that macro backdrop, let's look at how we've set up our funds. So this is the asset allocation of the high equity balanced fund that we run. So remember, this is a Regulation 28 fund. We're allowed to have up to 75% in equities in this fund, and we generally run it pretty high on the equity weighting. One of the ways to slice and dice the fund is to think of it as to how much of the fund is actually exposed to value. And I'm going to explain in the following slides what we think about and what we mean when we talk about value. But if I strip out the equity component of this fund, and you'll see we've got 49% of the fund in South African equities on the JSE, we've got a further 22% of the fund that is sitting in offshore equity, and then I've split out how that is comprised in the pie chart on the right-hand side. And the first thing you'll notice is that there's a very large component of that 22%. So 10% of fund is invested in the Russell 1000 Value Index. That's a reasonably large, chunky bet on value. But if you disaggregate our portfolio even further and you have a look within the South African equity space, and you go and define the various stocks that we're invested in the South African equity space as to whether they're growth or value, there's roughly another 32% of fund that is sitting in value in that SA equity component. And then if we look through some of the other indices outside of the Russell 1000 Value Index that exhibit value components, it takes the value component of the fund to just under 50% on our estimates. So 48% is the calculation that I did this morning, is the exposure of the fund to value. So it's a reasonably large bet that we're making, a reasonably large investment that we have in this concept. So what does value mean? I think the best way of looking at it is, let's look at the holdings of the Russell Value and the Russell Growth indices. So firstly, I've put up here the Russell 1000 Value ETF. And you'll notice across this ETF a number of familiar names, real economy stocks. So a number of banks. You've got Walt Disney in there, you've got Johnson & Johnson in there, you've got some energy companies, you've got some communication companies. And then if I show you the 1000 Growth ETF, you'll notice that it's very kind of tech heavy, very, very growth heavy. You've got companies like Apple, like Microsoft. Alphabet is the holding company for Google, and it's actually included twice because they're two different classes of shares. Tesla really needs no introduction, and then Visa and MasterCard. Now, what we will notice is, with the metrics that I've put up here, is that the value ETF has a low PE multiple. The low forward PE multiple at 16.7 times. Let's compare it to the forward PE multiple of the growth index at 36 times. So it's roughly half of the value index is trading at roughly half the forward PE multiple of the growth index. Then let's look at the price to book multiple. For those who don't know what price to book means, just to put it in simple terms, the accountants value the assets of the business, and that is the book value of the business. And then you just look at the trading price relative to the book value of the business. And you'll notice that value stocks generally trade on very low price to book multiples, or certainly relative to the growth companies out there. The final thing that's a determinant of value relative to growth, and which bucket you might put companies in, is that value stocks normally demonstrate a fairly high dividend yield. And you find that most of these companies here pay a decent dividend, while these ones in the growth environment pay a far less significant dividend than in the value space. If we look at the two indices over time, so the left-hand chart that I'm throwing up here goes back to 1995 and shows you the earnings of the Russell Value Index relative to the Russell Growth Index, benchmark at 100 at the start of 1995, and you'll see that for some time the value earnings grew at a faster pace than the growth earnings, and then since basically the 2005 2006, it's really been one-way traffic. The growth earnings have grown a lot faster than the value earnings, and what that is translated to on the right-hand side is the relative price performance of value versus growth. So in this environment here, you've got growth outperforming value. And then there's just been this little turnaround that we're seeing at the start of 2021. We made a call in our asset allocation fund, so our balanced fund and our flexible fund and in our stable fund, to start pushing the fund into value at around about sort of August, September last year. We were a little bit early, so we kind of got in here and have been starting to ride this relative wave of value outperformance over growth. And part of this webinar is to talk about that and why we think that will continue. And Murray's going to spend quite a lot of time explaining why we think that there's still legs in this value trade. This is an interesting piece of work done by Bank of America Merrill Lynch that have looked at the various value and growth cycles over time. So as you have seen from the previous chart, there are times where value performs and there are times where growth has performed. They've gone back to the early 1920s, so nearly 100 years ago. And on this chart, they've plotted the various value and growth cycles. So this is the peak of the value cycle, and that's the trough of the value cycle. And what you'll see here is there's been this huge relative underperformance of value over the last few years, as I showed in the previous chart. And that little tick up is the same tick that I showed you on the previous chart. And this chart here, what it does is plots those value growth cycles over the various time periods, and plots them for the number of months that value generally outperforms growth once you get into this upswing. The black line here shows you the average value versus growth cycle, and that basically just averages out all these different grayer lines. And that generally points to a 33-month average length of the value cycle. We're like 9 months into this value cycle at the moment. So just from a pure timing perspective, relative to the averages that have taken place over time, we think it's very early days in the value versus growth cycle. I'm going to hand over to Murray here, who's now going to talk to what we think will continue to drive this value growth cycle into the next, I guess, short to medium term.
Okay, thanks, Brian, and morning, everyone. So we know, everyone knows it's massive fiscal and monetary stimulation that's taking place and driving markets upwards. And the risks out there are inflation and the bond yields, the 10-year bond yield in the States. Where does that level go to going forward? Our view on that is 2%, basically 12 months out from now. It's sitting at 1.5 at the moment. And we still think in that scenario, equity markets will be okay and probably grind higher. So this chart from the BCA sort of explains quite nicely how much stimulus is actually taking place from a fiscal point of view. So if you have a look there, the green bars represent in the 2008-2010 as a percentage of GDP, about 5% of GDP was the stimulus that economies got in that period in time. Then we look at the black bars, and that shows the stimulus that happened end of 19 and last year. And broadly, if you average it, you'd say it's about 10%, double 2008, and in some instances a bit higher. I mean, Canada was monstrous last year. But the interesting thing is to have a look at what has happened this year, and particularly the US, which we think is the one area that has got big earnings surprises coming because of massive fiscal stimulation. So the gray bars there show there was a further 13% additional stimulus under Biden that has come in. Now, that means they've fiscally stimulated 25% of GDP. It's a monstrous number. And that's what we think is going to drive the growth in the States very strongly over the next 18 months to 2 years. So the next chart shows, this chart is the earnings expectations for the US. And it goes back to
expectations, Murray. The GDP growth expectations. You said earnings, it's growth. GDP growth.
Yeah, GDP expectations. And if you go back from 1 year, the red line at the top is the expectations for growth for 21. And you can see in the last 3 months, the expectations for growth were 4% for this year, and it is ratcheted up to over 6.5% for the States. And now that's because of this additional stimulus that's going in. That's a very big number. The middle line shows the expectations for GDP growth for 2022. And that has also moved up since the beginning of the year from about 2.7% to currently 4%. So there's a huge, almost 4% additional growth that's going to happen over the next 2 years in the US, which we think is going to cause very big upwards revisions in earnings, particularly domestic counters in the US. Another thing which we have talked about before and shown on slides is the extra savings that during COVID has been built up by individuals. So on the left-hand side, we have the total trillions of the different countries, sort of 2 trillion in the US. But more importantly is to look at the red dots. And the red dots expressed on the right-hand side is the amount of savings as a percentage of GDP. And the one that stands out again is the US. On the left-hand side, you can see that figure is 12% of GDP is in savings. Now that amount of that money is going to come to the market as things open up and probably go down to more normal levels of around 5%. So there's additional lots of pent-up spending. The next chart shows where this was a survey done by Deutsche Bank, showing where do they think the spending will be. And it's fairly obvious, I guess. We're looking at first priorities is going to be travel. I mean, domestic, global travel is going to be monstrous. Restaurants and food, as expected, very big pickup in tourism. The second area of the priorities are going to basic goods and services. So the opening trade, everyone knows about it, but I think we're likely to continue being surprises on the up as we move forward over the next sort of 12 months still, in our view. So how has this played out so far for the Russell Value Index, which Brian showed you before? If you go at the right-hand side and show for the Q1 earnings growth, the earnings growth for the Russell Value Index was up 54%. Now you'd expect it to recover pretty strongly, but very big numbers in growth. More importantly is to look how did the earnings go relative to expectations, and that is the earnings surprise. And there you can see that relative to earnings expectations, earnings beat by a full 24%. So we still think as we move forward, there are going to be revisions upwards, momentum, and this is a great environment for the value or domestic type counters to do well. And that's why we think there's still quite some way to go in this value stroke cyclical trade, particularly from a global point of view. Okay, so then
another poll up quickly. Sorry, Murray, to interrupt.
Okay, no problem.
Just a view on the rand. We're going to go into a bit more local discussion now around South Africa, and obviously the rand is very topical at the moment. So it'll be very interesting to understand the audience's views as to where you guys think the rand should be in the next 12 months.
Okay, so we're talking about the cyclical trade globally. And then the other thing, which we all know pretty well, being part of emerging markets, the rand is pretty cyclical. And we were up at 19 in the crisis, 19 to the dollar, currently sitting at 13.75. So we've been very strong. And what we show on the left-hand side is the emerging market bond index spread, MB. And that is, you can see that during the crisis, that got up to, on the left-hand scale, got up to 650 spreads over treasuries. And it has come right back down now to around the 350. So, and the rand has followed. So we correlate very highly with that. And we think, why is the rand so strong? Why is the rand so strong? A lot of the time, it's just explained by risk on. We follow EM as a whole. So that's generally what happens. And on the right-hand side, what we've done is inverse the copper price, and copper is representative of global growth. And generally, when there's strong commodity prices are rising sharply, the rand correlates pretty well and tends to do quite well. But let's look at a little bit more detail. So relative to the 23, I think it's about 23 emerging markets out there, the rand on the left-hand side, you can see has been the strongest emerging market currency this year. So it's not only EM's been strong, risk on trade, we've been the best around. Now, who would have thought that 6 months ago? We're all pretty negative what's going on. Fundamentally, long-term, there's some big issues. But from a cyclical point of view, we got hammered so badly, and we are in the sweet spot at the moment. And we'll have a look at why. Obviously, because of the commodities, commodity prices, agric, etc. Firstly, to look at this, this is a current account, which we've gone back to 1990. So the current account obviously is a trade account, which will be goods and services, that you have your exports less imports, and then you take the services and your dividends come off it at the end of the day. We're going to have, and it's interesting that we'll be getting at 11 o'clock today, I think we will get the numbers for the current account for Q1. It's going to be a big number. We think it probably could be more than 4%. But having a look at that, the bar charts there show the levels of our current account as a percentage of GDP. If we go back, we currently for Q1 sitting at just 2%. Now, the last time we were 2% in South Africa, you have to go all the way back to 1995. We've been running a deficit, all those negative bars there, of around about 4% a year. So we have swung around massively. Our trade surplus number could be closer to 10%, but our current account, probably Q1 is going to be extremely strong. And we think by year end, we could be sitting at sort of around 3%. Now, that is a big primary driver why we're doing so well on the rand. And what's driving it is commodities. So this is the CRB index. And you can see how commodity prices have moved up from 2020 in the crisis, from 350, the index, to 550. So a very big increase. And more importantly, why we are on the sweet spot is because of our biggest export is actually platinum group metals. And particularly rhodium is the biggest component. So if you look at that, we have gone up basically fourfold since 2017. This is the basket, the platinum basket. Rhodium makes up about 50% of that basket. And then palladium's about 25%, and then platinum is below 20. So there's been a big change, but rhodium is the biggest driver. So this is why our exports are so strong. We are just printing cash and a lot of dollars coming into the country, and that's why we're running it close to 10%, just the trade account, which is unbelievable. We just haven't been there for many decades. The other thing that's doing well is agric. Agric is doing very well. What we've done is one of our biggest components of agric is obviously maize. And last year we did 14 million tons, pretty big number. And for this year, it should be even more than that. But it's not only maize that's doing well. It's the citrus industry record numbers on the export side. We've got avos that are doing unbelievably well as well. And then even, would you believe it, even sort of cotton wool exports, we're doing quite well on that as well. It's a small part, but it's doing quite well. So some big drivers out there. So how are we positioned just generally?
Before you go into that, let's just share the results quickly. So as you can see, majority feeling that perhaps the rand's a little bit stretched at these levels and perhaps could weaken over the next 12 months. But a few do feel that it's a bit stronger, but certainly, yeah, I think the majority think that the rand could do with a bit of wrapping up in cotton wool at the moment at these levels.
Okay, good. Thanks, Mike. Okay, so this is across our funds, our equity positioning, just a flavor of what we're doing. On the global consumer BAT we've had, which has performed pretty poorly, I must say, for the last six to 12 months. You are getting a running 12% dividend yield, 7.5 multiple. So it's pretty solid in the portfolio. We have a decent amount of that, but it's a low rating and it's stabilized in the portfolio. Naspers, we have decent amounts of that. We've talked about that at length before. It's trading still a look through 40-50% discount. We are pretty disappointed in the restructuring that's taking place now. It's not ideal what we would have liked to see, but notwithstanding, 10 still trades, which is 85% of the NAV. It's still trading, if you strip out associates, at around a 20 forward multiple. Big, strong growth going forward. And then you're getting a big discount, a look through of close to 50%. So it still looks on a long-term basis very attractive. Healthcare stocks, I think we're a bit of an outlier there. We own Netcare, Mediclinic, and we own some Aspen as well. And the balance sheets are very strong. They've gone through quite a torrid time, but the valuations look pretty good. So we still think that it's a good sector to be in, particularly as we move into next year. Financials, we've had quite a lot. We had a lot of banks. We trimmed those and shifted a bit into insurers, which we think are more attractive. But we have a combination of both, but more insurers and very attractive. And then on the resources, we've probably still got about 28% across our funds. Diversified miners, very attractive. And the platinums, which are under a little bit of pressure at the moment with this chip shortage that's going on globally, with platinum and palladium prices coming off, we still think they look very attractive. On consensus, on spot earnings, still giving you more than 20% free cash flow yields. That's broadly where we're sitting. Just on the bond curve, what this shows here is the yield curve for our govie bonds. The short end, so we've shown it at the beginning of the year and where it sits now. Just what has happened since the beginning of the year with this good news. Now, broadly speaking, at the long end, which is from the 15-year out, we've seen a narrowing. So risk has come in. There's about, on average, 40 basis points shift downwards in our bonds at that level. Whereas in the short end, you can see that what has happened there is you've gone up about 40-50 basis points. So the curve has flattened slowly beginning of the year, as I think the risk factors on our debt and that people are saying aren't as bad. And we've been positioned our funds pretty much quite long duration. So we've been sort of really between the 15 and 20 year bucket. So we're picking up a bit of that in our multi-strat funds.
I mean, just to remind people, Murray, that you make money when you move down in the yield curve. That's a good thing to move from the grey line to the red line. So we've done reasonably well with our bond exposure in the multi-asset class funds.
No, absolutely. Okay, very briefly on the Flex Fund, that's just the history. Year to date is up 14%. Next slide, Rhino. And this fund really targets CPI +5 and tries to beat the Aussie, basically. That's the objective from the fund, with lower vol than the Aussie. So since inception has done well, it's 12% compound, so it's ahead of our CPI +5 sort of objective. It's beaten the Aussie by 2 and a bit percent, and it's beaten the Cap Swix by almost 4% compound per annum. So it's been so good. It's been pretty decent so far. Year to date is doing decently as well, sort of 14 or so. Next one. And our positioning, just where we are, just to give a flavor on the left-hand side, our equity component in that fund is running high because we think equities look pretty attractive, particularly domestically. 80%, we have 80% there. If you can just hover on the spots, Brian. So 80%, and the SA component is 67%. So our foreign component is only 15%, with a big portion of that in the Russell Value Fund, exposure to the US and value cyclical trade. Fixed income, we've got 9%. We've got a couple of percent in our bond fund, which is running a yield of around 8% in dollars. And then in SA, our bonds there, the 2035 bond is what we've got there, 7% or so. Stocks, Naspers, you can see Anglos and sort of decent position in that. And the Platinums, Anglo Plats, Impala. ABSA has been our preferred bank in the banking sector. It's done pretty well. And then insurers, you can see Sanlam's there. We've got Momentum's slightly lower than that, just under 2.5%. And we have, we have MMI, Sanlam, Liberty, our insurers there. And we do have First Strand in there as well, plus some Standard Bank in the bank side if we go further down. And so with that, I'm going to hand back to Mike, and we're going to go into questions.
Thanks very much, Murray. Great, we've had a few questions coming through. Just a reminder to any of you, if you do have any more questions, please feel free to pop them on the Q&A. One of the questions raised early on in the discussion, probably to do with the raising of the fact that we've been appointed to the Net Group mandate, was that we have recently, well, not recently, within the last year or just over a year, switched to a multi-councillor approach on our equity fund. And within that, we've introduced 2 new portfolio managers. So throughout the history of the fund, it's been managed by Gavin and Murray equally. They come to decisions together on that fund. And then more recently, last year, we introduced Dwayne Dippenaar, who's been with the firm for over 5 years and has got a lot of experience in the equity space. He's been one of the senior analysts in the resources stocks as well as others. And then also Junaid Bray, who joined us 2 years ago and has got decades plus of experience in managing portfolios from his previous house. So they've come in and they're both managing a slice of the equity fund along with Gavin and Murray. Gavin and Murray still maintain the majority of management of the fund. But yeah, just to elaborate on that new structuring. Next question from Mark, one of our regular attendees. Within the Africa bond portfolio, I'll pass over to Brian.
Yeah, Mark, the Africa bond fund that Murray referred to, that we're invested in both the Flex and the Amplify fund, and actually our stable fund. So that is invested primarily in African Euro bonds across a wide variety of different African countries. And you'd be familiar with the concept of a Eurobond, that you're not necessarily putting your money into the country itself. Eurobonds are Euroclear settled, and as a result, you're not putting money into the actual country. You asked a question about whether there's money in Nigeria. There's no local debt that we own in Nigeria in the fund. We've got a bit of a position in Eurobonds, but we're not stuck with the problem of having money stuck in Nigeria as a result of those Eurobonds. So it's a wide selection of various African countries that we have exposure to in that Eurobond fund. We're very happy to share with you, sort of outside of this forum, the makeup of that fund.
Thanks. And then from James, perhaps from Murray, where do you see the US CPI? Where do you see it going?
Right now, higher. Look, it could quite easily go 5-6%. It's quite possible, but I mean, we've seen what the Fed has said, that they expect it to normalize and come down. I mean, it's a sort of is a good chance it doesn't come down as much as what they think if you get 12 months out from now. And linked to that, obviously, the short rate. So the best indication we can get is from the Fed's dot plot, where the 19 voting members all vote. And consensus is that the first time short rates go up is in 2024. Now, that it seems more from our view that it's going to be earlier than that, and that there might be a bit of a surprise on inflation. But yeah, it's going to be very high now. The question is, how does it come? If you roll forward 12 months from now, does it come back down to the level of 2%? Expectations in the market around 2.5%. I think that's what the bond market seemed to be projecting. But yeah, difficult to call, but we think long bonds are going higher. So at 1.5 at the moment, we think by year 12 months out, we're sitting at 2 and possibly even sort of 2.25% by end of next year. But it is a risk, a big risk out there, yeah.
Thanks, Murray. Another question from Mark. I heard that miners are not growing. What happens when our supplies run out?
I can maybe answer that. I mean, we've been listening to quite a few corporates in the last couple of days, and was on one in particular, which was Sibanye. We're on a call with them yesterday. And the big thing, when you look around, there's no big fixed investment spend going on mining in South Africa. So fixed investment is what drives longer term growth. And those numbers are quite from the private sector, very low. And you have Sibanye that's spending a lot of money growing, investing in new mines internationally or increasing ounces, when South Africa, there's very little increase of new ounces. So there's no real volume growth. Amplats might come in and do a bit, but it's small in the whole. So I think confidence is a big issue. We're getting massive, there's a cyclical trade in South Africa at the moment that with these high prices, but I guess when the prices, if prices of platinum in particular, PGM metals come down over the next sort of 18 months, I think they're going to be relatively high as our view, because they're restricted on the supply side. There's limited supply and demand's quite good. But if they come down significantly, then there will be quite a problem, because I mean, our ounces on platinum at best are probably going to stay flat, that we produce the PGM metals flat going forward. And as you say, gold, we've seen the ounces of gold steadily go down over the last 20 years or so. But yeah, look, it's a long time till we run out of them, though. But there's no new fixed investment, very little new fixed investment.
Thanks. Then a question from Patrick on the chat. Thoughts on SA mid and small caps, given the prevailing positive sentiment on the SA economic recovery?
Do you want me to take it, Murray? You go for it.
Okay.
Go for it.
Okay, so small mid caps. I mean, we've seen domestic SA. A lot of people have been very underweight domestic SA, and you've seen the surprises of the retailers this year to date, very strongly up, some of them 50% or so. Our valuations in South Africa got extremely low because everyone was getting out of South Africa, and the rebound coming through because of these commodity prices being a lot higher, and the spending being a bit better as well, is driving some of these stocks to perform. So retail's performed very well. We've just started seeing banks doing quite nicely year to date, sort of updates from all the major banks in the last week that their earnings are going to be better than expected. And then if you go further down the list to some of the smaller caps, I mean, the one is still insurance. Insurance, we think, is the one sector that's got very good upside over the next 12, 18 months, very cheap. Some of the mid caps, we own Hudayco, which we think is, the results should be quite soon. We think they'll surprise on the up. in some of our funds, not all, we own some Invicta, which we bought, and that's been very strong. And that's also some of these mid caps valuations just got way too low. And I think there's a bit of a correction as the earnings recover. So we do have a few across the funds, but it's liquidity wise, some of them are not easy to get into. It takes quite a while and you need to be early. But I think that space is still going to see some relatively decent performance. We've got some of the stocks we own, say Mustec and Alviva, which these things are, it's going to be unbelievable what these earnings do this year. I mean, these things are way more than doubling earnings, record earnings, what's coming through in these things. And you're buying these things on sort of three multiples. We actually got a pre-close call now with Alviva after this. But yeah, I think there's a couple of stocks that look very attractive in this space that are going to big upside.
Thanks, Barry. So one more from the chat from Ernest. You're buying. Sorry, let's just move. You're buying more value in your portfolios. Please explain how this move ties back or fits into the Laurium investment process. Maybe for you, Brian.
Yeah. So there are two components to that, Ernest, in terms of the investment process. We started off with that slide. You might recall the cogs with the bottom up, which is most of what we do, and then the macro component, which is 20%. So the value component of particularly the international value component in the multi-asset class funds is a function of a macro view that we've taken, that Murray and I have hopefully given you a bit of background as to why we took that macro view back in the latter part of Q3 of last year. The value component that ends up in the individual stocks, primarily the individual South African stocks in the portfolio, is more a function of the bottom-up work that we do on the stocks and the valuation of those stocks. Murray's just done a reasonably good job talking about some of the small and mid caps that we own, the fundamental analysis, the valuation of those businesses, and the upside that we think there is in those businesses then drives whether we own the business in the portfolio or not. So it's a combination of two things, the macro view and then also the bottom-up fundamental work that we do on the South African companies.
Thanks. Then one from one of the other people. Why is the foreign exposure in the Laurium Flexible Fund so low? Maybe for you again, Rana.
Yeah, I mean, the Flexible Fund has a number of different objectives. It has a CPI plus objective. It also has an objective of trying to beat the market in South Africa. And in fact, if you stack up the Flexible Fund against other South African equity funds, it stacks up very well since inception. If memory serves me correctly, it either would rank second or third in that category. I don't know, Mike, second or third, something like that, relative to the equity funds.
Yeah, so that's right. It's third, yeah.
And at much lower volatility actually than other equity funds, than comparable equity funds, because we mix up some bonds and some foreign equity. So with that objective of wanting to beat the local market, you end up owning a reasonable amount of the local market. It's a flexible fund, so it can own whatever it would like to own. At this point in time, I think valuations in general in South Africa to us look more attractive than internationally. Obviously, we see more value in the value component of the international markets, but the broader international markets at the moment, from an equity perspective, look reasonably full to us, with more upside potential in South Africa. So it's those are the main reasons that we sit with a lower offshore component than we would have in, say, our SCI Balanced Fund.
Great, thanks. We are running a bit tight on time, so I thought I'd just mention that we did have quite a few people that were correct in terms of coming up with the word, which was mentioned by both Brian, Murray, and then myself. It was cotton wool, so well done to you guys. The first one to come up with it is interesting because one came up with it on the chat and the other one came up with it on the Q&A at exactly the same time. So I think we might have to be issuing two rewards in this case.
Who was it? Who the eagle eyes?
So the eagle eyes, congrats to James Downey and to Craig Shalor.
Ah,
well done, guys.
I have Craig Shalor's wine. He doesn't drink. So, no, thanks, guys. Thanks for participating in a little bit of fun, and we'll make sure we get the bottles of wine across to you. And yeah, thanks again for joining us in the boardroom. Hope you found it interesting, and we'll do another session in the next 6 weeks or so.
Yeah, thanks very much, everyone. We'll answer. There were a few more questions in the Q&A. We'll come back to you post the session directly. But thanks very much for joining us today. We had a good attendance, about 150, which we're very chuffed with. So thanks for joining us.
Thanks, everyone.